Metro Retail resets dividend expectations. Expansion absorbs cash, while the regular 0.06 pesos payout remains credible, but not guaranteed. This is an MRSGI research presentation from the first half financial results of Metro Retail Stores Group. Improving earnings support the dividend, while store expansion constrains the cash available to shareholders. The 2026 dividend per share is 0.06 pesos, with a gross yield of approximately 5.6% at 1.06 to 1.07 pesos share price of MRSGI. The 2025 earnings payout ratio was approximately 29%, and 2025 free cash flow was 290 million pesos. The base case is that 0.06 pesos is repeatable. The risk is whether operating cash flow can keep pace with capital expenditure and working capital needs. The 0.16 pesos total in 2024 included a 0.10 pesos additional distribution. In 2024, the payout was 0.06 regular plus 0.10 pesos additional. In 2025 and 2026, the regular payout was 0.06 pesos. Treat 0.06 pesos as the starting run rate and do not capitalize the 2024 special dividend as recurring income. Earnings coverage is the strongest part of the case. Profit growth accelerated despite only modest comparable store sales growth. 2025 net income was 682.6 million pesos, and 2025 earnings per share was 0.21 pesos. The first half 2026 gross margin was 22.6%. A 0.06 pesos dividend divided by 0.21 pesos earnings per share produces an approximately 29% payout. Growth is widening the earnings base and raising the cash bill. There were 8 net new stores in a year, along with renovations of larger stores and hypermarkets. Expansion requires property improvements, equipment and fixtures, opening inventory, pre-opening costs, and a ramp-up before store maturity. Expansion can lift future earnings while reducing today's distributable cash. The dividend is covered by cash, but less comfortably than by earnings. 2025 free cash flow covered the payout, but the margin of safety was narrower than the 29% earnings payout ratio implies. Cash dividends consumed 67% of 2025 free cash flow, calculated as 195 million pesos divided by 290 million pesos. The payout was covered, but not abundant. A retailer can report positive earnings while expansion and working capital absorb most cash generation. Operating cash flow is cash generated by stores. Capital expenditure and working capital include new sites, renovations, and inventory. Free cash flow is the residual cash after investment. Dividends are a board discretionary return. A cut trigger is operating cash flow weakening, while annual capital expenditure stays near 1.4 billion to 1.9 billion pesos. In that scenario, the board could reduce or omit the dividend despite profitable operations. The balance sheet provides flexibility, not immunity. Liquidity is adequate, but debt and lease obligations keep capital allocation consequential. Current assets were 9.84 billion pesos. Current liabilities were 6.40 billion pesos, and the current ratio was 1.54 times. Total equity was 10.04 billion pesos, with 1.27 billion pesos in cash and investments versus 9.06 billion pesos in reported total debt. MRSGI cannot treat store expansion and dividends as cost-free choices. Watch cash after the stores are built. The dividend case is credible, but the special payout case is not. The base case is maintaining 0.06 pesos, supported by rising earnings and a conservative payout ratio. An upside special dividend requires substantially stronger cash generation or slower capital spending. A cut or omission becomes plausible if operating cash flow weakens while capital expenditure stays elevated. The number to watch is free cash flow after store expansion.